The truth about what is coming. Chamath Palihapitiya's latest interview on a coming recession. What is going to happen to the economy next? Are we going towards a path to recession in 2022? The federal bank is also increasing its interest rates. Housing prices are increasing, with the highest inflation ever registered in the past 40 years. What should I do next? Everyone is panicking with these questions these days. Let me know in the comments whether these questions arise in your mind this year. At the beginning of the year, the news was filled with the fear of rising inflation, and on top of that, stagflation was busted out. Then a war started in Ukraine, and of course inflation rates kept rising. When disrupting the supply chains, taking out debt, and printing money at scale for transfer payments, which create new demand, rising inflation is the logical endpoint. The big question is, what happens next to the economy? Welcome to CryptoTrends. In today's video, you will get to know about Chamath Palihapitiya's latest interview in a coming recession. So make sure to watch the video till the end, and don't forget to like and share the video. Many experts are guessing what is about to come in the near future. In today's video, we will discuss what Chamath Palihapitiya said about the coming recession in his recent podcast of All In. But before moving along the video, let's know a little bit about Chamath Palihapitiya. Chamath Palihapitiya is a Sri Lankan-born Canadian and American venture capitalist engineer, a Silicon Valley venture capital investor who has made himself into a tech firebrand. He is a proponent of SPACs, SPACs, a kind of investment vehicle that allows private companies to go public with less scrutiny from the SEC. Palihapitiya is a sponsor and investor in half a dozen SPACs. Companies that they have merged with include Virgin Galactic and Clover Health. Palihapitiya was an early senior executive at Facebook, working at the company from 2007 to 2011. Following his departure from Facebook, Palihapitiya started his fund, the Social Plus Capital Partnership, through which he invested in several companies, including Yammer and Slack. The Social and Capital Partnership changed its name to Social Capital in 2015. He is also a co-host of a technology podcast. Chamath said on his Twitter, "History repeats itself. In 2018, the Fed was concerned about inflation. They were wrong, and within a quarter or so, the risk shifted to recession. History shows that phases of stagflation and recession were not of long duration. And yet, whenever those terms hit the news, fear spreads. High unemployment rates and rising prices are the breeding ground for social instability that sometimes has the potential to evolve into a major war. Economists have ruled such scenarios out in their models, mostly. One of the most prominent descriptions is the Phillips curve. This model can be mostly either unemployment is high or the inflation rate is high. But the 70s showed that this isn't always the case, and stagflation exists in reality. Due to the oil price shock, inflation rates rose, as did unemployment. Economists fear the stagflation monster since not much can be done against it. The good news is that it usually goes away after a couple of months. Due to the pandemic disruptions of supply chains, lockdown policies, and printing of money, some economists argue that the societies in Europe and the US might have to face such a scenario again, a rise in unemployment and high inflation rates. At least we already got the second one. The economy is set up for growth, which guarantees employment across all industries and keeps unemployment rates low. An economy that provides sufficient labor to their people, of which they can finance the lives of their families, is key to social stability. Temporary recessions often occur after a long period of growth and are usually short-lived. Sometimes taking a break is not only healthy for humans, but also for the economy. The biggest problem is depression, as experienced in the 30s in the last century. High unemployment paved the way for World War II. People with no work have no money and no hope. Suffering through hunger and homelessness are the breeding grounds of extremist philosophies. Giving people work and letting them do their daily business is the best way to secure lasting peace in society. To avoid a scenario of inner conflicts and long periods of instability, politicians and economists try to find precursors as a warning sign for stagflation and recession. One of those is negative interest yield curves. Interest rates define the percentage that banks pay to their customers for lending money to banks. The yield curve usually is low in the short term and high in the long term. It follows a simple principle. When someone lends money to a bank for a couple of days in a savings account, the bank can't do much with it. That's why the interest rate on short-term savings accounts is low. When a customer agrees to let the capital sit for 10 years, the bank can issue long-term loans at a much higher interest rate and make a profit from this business. That's why long-term rates are high. The curve is low in the short term and high in the long term. Is the negative yield curve a great precursor? What is the big problem in the media? Some economists argue that parts of the yield curve in the US have inverted. I still consider Europe closely tied to what is going on in the US, so this might also be relevant to Europe. The economists closely monitor the 2-10 spread, 2 years of interest rates with 10 years of interest rates. However, some studies show that this spread isn't a great precursor for recessions. The Federal Bank demonstrates in an article that the short-term forward rates are much better precursors, and those spreads are going up instead of flattening and going to zero. What does that mean for investors? According to Chamath Palihapitiya, the situation of a looming recession was part of the All In podcast last week. Palihapitiya described the federal bank observation and came to his conclusions for investors. When the economic going gets rough, businesses with wacky models get slaughtered. Those who have a handle on their customers and know how to operate profitably might not show the soaring stock prices that everybody got used to in the last 10 years, but have only moderate setbacks in their stock prices. It is what happened during the last 6 months. Many public growth stocks with not yet profitable business models lost about 80 to 90% of their market capitalization. And yet, when I look at the stock market indices, they are all still close to all-time highs, which means healthy businesses will continue to operate well and increase their intrinsic value. The first sign that investors will notice is the recent spike in energy prices. According to Chamath, during that, he said that anytime energy prices have jumped by 50% or more in the last 30 to 40 years, a recession has followed. Let's take the price of crude oil, for example. This time last year, crude was going for $62.77 per barrel, but now it's going for about $117 per barrel. That represents an 86.4% increase in crude oil prices year over year. Another factor to consider is the rising price of wheat due to the Ukraine crisis. He notes that the last time wheat was this expensive, the global financial crisis ensued. The Federal Reserve's plan to increase interest rates could also be a sign that a recession is coming. The Fed plans to increase interest rates to combat inflation, which is likely sitting at 8% now. However, moving forward with interest rate hikes is likely to crash the economy. Another thing to watch is yield curves, according to Chamath, and specifically, traders will want to keep an eye out for an inverted yield curve when prices head higher but yields are lower. An inverted yield curve has preceded every recession in the U.S. since 1955. Investors need to make sure to keep an eye on these factors as we stray closer to a recession. Should you be worried about a recession? This hasn't been the most enjoyable economic expansion in history. While the S&P 500 has almost doubled from its post-pandemic lows, the current bull market has been defined by high volatility and low consumer confidence. Thanks to high inflation and supply chain issues, Americans aren't feeling optimistic about their finances. The most recent survey found that people haven't moved on from the COVID-19 malaise that's defined the past 2 years. Meanwhile, housing sales are declining as financing costs rise, and there's a dearth of homes on the market. Should the trend continue and worsen, that might augur a recession. Nevertheless, the economy is still growing and doesn't appear to be showing any signs of real recessionary trouble. Of course, Russia's war in Ukraine hangs all over this, but it's not as if stocks suffer just because crazy events are going on in the world. After an initial decline following the disastrous Afghanistan withdrawal, for instance, stocks rebounded a few months later. The hardest thing to do is to keep perspective, but that's generally the best medicine. So I think we're at the end of the video, and I hope you enjoyed it and it may be helpful in your crypto investment journey. If you liked the video, let me know in the comment section below and subscribe to the channel for more amazing videos. Thanks for watching!